All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So if you've been scouring the internet looking for information on how to invest in real estate using life insurance, you've come to the right place. So be sure to subscribe to this channel right now. While you're down there, hit the thumbs up button. And if you've got any questions on the content of this video, be sure to post them in the comments below so that I can respond and get back to you and let everybody else have the benefit of that. One of the goals of this channel has always been to dispel the myths and misconceptions of life insurance. And the question I want to tackle today, or the myth I want to tackle today is whether or not you need to use a mutual company to do any kind of private banking strategy like the double play or infinite banking or bank on yourself or any number of different strategies. If that sounds interesting to you, stick around after the intro and we'll get started. All right, thanks for sticking around. I'm Tomrutkowski with Innovative Retirement Strategies, and this is the Double Play channel. I created this channel because I know how hard it can be to try and find information on not only this subject, but any subject that you're trying to find online. You know, you find websites that have lots of pretty pictures and tell you the right thing in little blurbs, but ultimately they want to get your email address so that they can add you to their marketing, and they don't provide a lot of information online. If you will check out my channel, my videos, my website, you'll find that I have a ton of information, all freely available. And I do that because I know that most people want to do business with somebody that knows this field. The goal of this channel is to give you everything that you need without ever talking to a life insurance agent to get the most efficiently designed policy possible for the double play. That is leveraging the cash value of a maximum overfunded life insurance policy to invest in real estate. So the only time that you should ever need to reach out to me is when you want to see what those numbers look like for you. But I assure you, almost every question you can possibly have is available on these videos and on my website. If you find this information valuable, please consider supporting this channel. Be sure to like the video, subscribe to this channel, post a comment in the comment section down below. And if you want to support me monetarily, you can go to buymeacoff.ee. There's a link in the description, and consider supporting this channel financially. That provides me an incentive to keep making these videos for you. So with that, let's get on with it. Today we're going to be talking about mutual companies versus non-mutual companies. Is it hype or BS? The goal of this video is to show you that the company structure doesn't matter. You should be choosing a policy based on an apples-to-apples comparison of different illustrations and choosing the one that works best for you. The ownership structure of the company plays no role whatsoever in the best policy for the double play. So what I want to do in this video is basically, just so we're all on the same page, I just want to explain the difference between a mutual and a non-mutual or stock company. And then I want to just revisit the idea of private banking strategies and discuss, what are the absolute requirements for private banking strategies? And then we'll just kind of look and see, is the ownership structure of the company something that's critical to a private banking strategy? Then we're going to take a closer look at just the differences between the types of policies, features that are important, differences between the policies. And then I want to really just cover, what should you be looking for in a policy? Before we get started, let me just cover a couple of the housekeeping items. The purpose of life insurance is for death benefit protection. Any other benefit is purely ancillary. And I just want to point out that all of these videos are purely educational in nature. There's no tax advice, no financial advice, no legal advice, and frankly, no selling. This is all just educational. So, all right, so let's get started. So what is the difference between a mutual company and a stock company? The primary difference between a mutual company and a stock company is the ownership structure. A stock company is owned by the shareholders of that company, and a mutual company is owned by the policy owners of that company. but they're all regulated by the same state insurance boards. They all are subject to the same laws. They all work exactly the same. There's no functional difference between policies. If there are any differences, it's more subtle in how the companies can raise capital. Obviously, a stock company can issue more shares to raise equity, but both types of companies can issue bonds in order to raise cash. So there are a million videos out there. I mean, if you just type into Google mutual versus non-mutual or mutual versus stock, you will find literally thousands of articles covering the differences between these types of companies. But really, the purpose of this video is to focus on whether or not that whole premise that to do infinite banking, you need to have a dividend-paying whole life from a mutual company. So when you search online, this article from Investopedia comes up at the very top of the search results. And as I was reading it, the few things that struck me, I've highlighted or underlined in red here. So let me just read this. The key difference is, like stock companies, mutual companies have to abide by state insurance regulations and are covered by state guarantee funds in the event of insolvency. However, many people feel mutual insurers are a better choice since the company's priority is to serve the policy holders who own the company. With a mutual company, they feel there is no conflict between the short-term financial demands of investors and the long-term interests of policy owners. Well, feelings are great. Whenever I am working with a client, I mean, I want them to feel good about buying the policy, that they're making the right decision. However, when you're evaluating those policies, I want to see facts and data. And most of my clients want to see facts and data. They want to know that they're getting the best possible policy design so that they feel good about making that decision. So feelings at this point in the decision-making process really don't matter. Hard facts do. So let's take a step back now and just look at private banking and think about what are the absolute bare requirements for private banking strategies. Well, private banking strategies require a permanent life insurance policy, not term. Term doesn't have any cash value, so it's got to be either a mutual or an indexed universal life, and it can be, frankly, in my opinion, a mutual or a stock company. There's no requirement there, just so long as the policy has cash value. And beyond that, the ability to borrow against the policy's cash value is written into the state statutes in all 50 states. So every insurance company is mandated by state statute to make loans to their policy owners secured by the cash value of those policies. So there's no ifs, ands, or buts. There's no application to fill out. They're required to give you loans. And those two things are what make infinite banking and different private banking strategies, the double play, work. It's the ability to borrow against an asset that's working and generating interest or dividends and use that leveraged cash to invest in something else like real estate investing. All right, so the next thing is, I mean, are there differences between mutual companies and non-mutual or stock companies? And the answer to that is clearly yes, but there's differences between all companies. I mean, I don't have the time or resources to run illustrations for the entire universe of universal, index universal, and whole life policies, and across the whole gamut of stock owned or mutual owned to rank order them and tell you which ones are the best. So another tool that I want to show you that will help dispel the notion that the company's ownership structure matters is just an understanding of how life insurance policies work. So you guys have all seen this graph before, unless this is the first time you're watching one of my videos, in which case you probably haven't. But this graph is featured in a lot of my videos, in a lot of my blog posts online. And what this is showing is the death benefits and the cash value for a typical minimally funded life insurance policy. And if you don't understand the difference between a minimally funded policy and a maximum overfunded policy, by all means, go back and watch the Life Insurance 101 video. And I've got a separate video that dives into minimum and maximum overfunded policies so that you understand. If you're researching infinite banking and private banking strategies, these are policies that work best with maximum overfunded policies. But this graph, this shows what most typical life insurance policies that are sold for death benefit look like. The goal here is most people want to get as much death benefit as they can for as cheap as possible. So in here, we're looking at a 45-year-old who's getting a policy with a $1 million death benefit, and that's the orange line, the horizontal orange line across the top. And the cash value, for all practical purposes, represents the owner of the policy saving up the death benefit over the lifetime of the insured. So that blue line grows ever so steadily all the way up to the point where it's reaching the $1 million death benefit. Now, the insurance company is the one who's at risk for the gap between the $1 million death benefit and the cash value. So at age 45, at the very far left corner of the graph, you can see that there's very little death benefit. Very little cash value and a lot of death benefit there. So if the insured were to step off of a curb or get hit by a bus, the insurance company has got to come out of pocket for almost the entire $1 million. But thankfully, most 45-year-olds make it to 46, and the cost of insurance is relatively low at that point in time, easily handled by the premium. But over time, the cash value grows, and by the time that person reaches about age 83, you can see that they've saved up about half of the death benefit, and the risk to the insurance company is only the remaining $500,000 between the cash value and the death benefit. So the death benefit is really the sum of the cash value plus the remainder of the gap that needs to be covered. So it's a pretty simple product. It's a cash savings component bundled to basically what amounts to 1-year term. So you can see here that the insurance company has an incentive to grow the cash value as quickly as possible. They could invest in riskier assets that perhaps earned a higher rate of return, but it's imperative that they not lose money because they can't afford to pay claims if they don't have the money. So the two goals of an insurance company are to grow the money as quickly as possible, and two, as safely as possible. And because it's life insurance, they don't need to hit the ball out of the park. They just need to make sure that that money grows at a nice, safe rate over the course of the lifetime, and then they can plan the rest of it. But you can see here that if the cash value, the blue line, if that cash value were growing at a faster or higher interest rate, that blue line would grow more steeply and would intersect with the orange much earlier. So you can see that the insurance company has an incentive to grow the cash value. And that's unlike nearly every other thing that you can put your money into. I mean, think stocks, for example, right? Your financial advisor is going to make money whether the market goes up or down. The banks don't care. No matter how much you put on deposit, they're gonna pay you 0.5%, and they're gonna turn around and loan that money out and make much higher rates of interest on it. So that's true for them no matter what interest rates are at. They'll always pay you less than what they can make by lending it out. So here, the insurance company's motives are aligned with your motives, and they have an incentive to grow the cash value as quickly as possible. So that said, is there a difference between mutual companies and non-mutual or stock companies? And I would argue that since this market is very competitive, I mean, so let's look at this from an economic perspective. For example, life insurance is a fairly generic product. I mean, life insurance companies can introduce different riders to try and differentiate their product, but for all practical purposes, it's like grain. It's a simple product that's pretty much the same and offering the same across any company that's offering it at its core. Now, what separates it from other perfectly competitive products, to use an economic term, is the high barrier to entry to get into life insurance, because insurance companies need to have the financial resources to pay claims to build wealth and manage it. So not everybody can get into it. But nonetheless, it is a fairly generic and competitive product. So no company can go out and charge an outrageous amount and get away with it without losing market share. So I'm going to argue that given the market pressures, that again, there's no difference between mutual and non-mutual companies. Otherwise, everybody would go to the cheapest mutual company they could find and do their business there. There wouldn't be any incentive to go with a stock company. So how should we choose a life insurance policy for a private banking strategy? Well, me personally, man, I've already whittled down the entire field of possible candidates down to those few that have the features that I need in a policy. Now, I should note that most of the policies that I write are in fact from mutual companies. But that's not to say that I'm choosing those because they're a mutual company. But here are the factors that I consider when I'm looking at a policy. Is there a way to waive the surrender charges? Because my clients, when they're doing private banking strategies, want to have early access to the cash that you're putting in a policy. They don't want to wait many years for it. The next, I'm looking at whether or not I can get a variable policy loan right away. Many companies make you wait for up to 5 years before you can get a variable loan. In the case of an indexed universal life, I want that ability from day one because that's what creates or sets up the opportunity for an interest rate arbitrage between what the policy's cash value is making and what the loan rate is. The next thing is are the loans non-direct recognition? So here, when you borrow against the policy's cash value, is the insurance company treating it like it's a loan secured by the cash value, so the cash value is actually still growing and earning interest? Or are they not paying any interest or dividends on the cash value that's securing the loan? That's what's called direct recognition. So clearly, if you want your money to be working in two places at one time, you need to be using a non-direct recognition product. In any case, I mean, I always recommend that my clients at least go out to a third-party bank and get a cash value line of credit. So you're literally posting your policy's cash values as a cash value as collateral for a loan that you're getting from a third-party lender. So you have to apply for it, you have to pay interest, but it also gives you the ability to deduct the interest as a business expense if you're using the money to invest in real estate. Whereas policy loan interest is technically a personal loan and you can't deduct the interest. But there are times and places where you definitely want to borrow from or against the policy's cash value. All right, so more intangible, now we want to look at what do the reserves look like? What kind of assets do they hold? So I am always going out to look at the annual reports from different companies, and there's usually a pie chart there that shows what they're investing in, what their reserves are invested in. And I want to see a very high ratio of AAA rated bonds. I don't want to see a lot of derivatives and other investments. And if you do that and you get used to looking at different companies, you're going to see that there's a big difference out there. And it doesn't necessarily correlate with the ratings that you see from Standard & Poor's and Moody's. So I implore you to get out and look at the reserves before you look at the ratings of the company. The next bullet point is what are the interest crediting options? So this is specific to indexed universal life, but I don't want to use a company that has 5 different interest crediting strategies, but they're all tied to the S&P 500, for example. So if the S&P 500 goes down, they're all going down. I want to see different indices, and I want to see other uncapped strategies and other things that allow you to earn money without being stuck by the cap. And the next bullet point is what are the cap rates? Again, specific to indexed universal life, but What I want you to understand here is the cap rates are a function of how much the insurance company is making on their reserves. So in the case of a whole life company, typically whatever's left after all the expenses of the policy are paid out is credited to the policy owners as a dividend. Part of that is your guaranteed growth rate from the policy or actuarial growth rate. And the rest of it, anything in excess of the guarantee that they earn, is basically, you can think of it as excess being returned back to you. You could think of that as shared surplus. So the thing about the cap rates is if one company is offering a much higher cap rate than another company, you have to step back and ask yourself, how are they doing that? Do they know something that the other companies don't? Are they better at investing or hedging with options? Or are they investing in riskier assets with a higher rate of return, which is giving them more money to play with for hedging and allowing them to capture a greater movement in the market? So that might look good for a couple of years, but then, when you're investing in risky assets, there's always the default risk of those bonds. So high cap rates don't always tell this whole story. Look at the reserves of the company. And then finally, what is the internal fee structure? All policies have fees. They're all different. What I recommend is that you run all of your illustrations with exactly the same interest rate so that you can see the differences in the results. If you're running all the illustrations with the same exact inputs, same exact premium, same exact insured, well, then the only thing that explains the differences is the fee internal fee structure of the policy. So that's what's important. It's important to understand that the interest crediting rates are just an assumption anyway. So, Mass Mutual, for example, may be using a 6% dividend rate today, and I could run an illustration showing 6% for the next 50 years. But that's not going to stay constant for 50 years. All we can do is pick a rate that represents the best estimate of how that policy is going to do over time. And that's very difficult to do because rates are always changing. So again, since it's just a guess, it's best just to run an apples to apples comparison across all the policies so that you can see whether or not the internal cost structure is different. That's the most important thing. Don't take don't choose one company because they're showing a 6.5% growth rate compared to one that's only showing a 5.5% growth rate. You'd be making a big mistake by doing that because there's no guarantee that projected rate is the rate that they're actually going to earn. Just run them apples to apples and see what they look like then. And next, you want to look at the company's balance sheet. Take a look at their assets. Again, on their annual report, you should see a pie chart of some sort that shows the breakdown of assets that they hold by category. And what you're looking for is a lot of, or a very high percentage of, AAA rated bonds. You want the best quality assets that you can that offer a moderate but safe rate of return. If you're seeing companies that are holding much more junk bonds and lower grade bonds, that's riskier, and there's default risk with that. So they could earn a higher interest rate, but how long? Higher risk leads to higher rewards, but it also potentially leads to higher losses. All right, so wrapping up, let's just cover the basics here. The type of policy doesn't really matter. It doesn't matter if it's whole life. It doesn't matter if it's index universal life. Under the hood, they all work functionally the same. Again, the only difference in an index universal life is quite literally the insurance company is taking the dividend that they would have paid you, and they're going out to the options markets and they're setting up hedges to try and capture some of the movement in the market with the money that they have to spend. So they're not risking your cash value. They're just hedging using the dividend that they would have paid you. So they wouldn't do that if they didn't know or expect that they can earn a greater return or a premium over what the debt market rate of return would have been. Secondly, the company structure doesn't matter. And as I showed, insurance companies have an incentive to grow the cash value as quickly as possible. They're, and they can't get outrageous with their fees and costs because you can vote with your feet and go to a different company and do your business there. So the most important thing that you can do is simply choose the best companies that have the features you need, work with an agent who understands this and can help you find those companies, and run the illustrations apples to apples so that you can pick the policy that's got the best performance without overestimating the amount of growth that it can achieve. All right, so that's all I have on this topic. If you're hungry for more information and you don't want to talk to a life insurance agent yet, I highly recommend going out to Facebook and joining the Double Play group. It's a community of like-minded people who are all there to either they're doing the double play or they're interested in learning how the double play works and access the information that I've got out there. But that's a great resource. There's also my website, and I consider my website to be a no fluff zone. So you're going to find a lot of good, solid information to answer all of your questions. Go there, read everything that sounds interesting to you, and I'm sure you're going to find the answers to most of your questions about life insurance. Again, you shouldn't need to talk to me or any other agent until you're ready to see what the numbers look like for you. And I should also point out that all of the resources available for this, the slide deck, there's a link in the description down below, or you can just send me an email and I'll send you the slides that I use in this presentation. On my website will be a link to this video, a blog post related to this video, and again, tons of other stuff as well. And finally, if you enjoy getting all this content for free, please consider supporting this channel financially at buymeacoff.ee. Any support that you give is greatly appreciated and gives me an incentive to keep making these videos. So with that, thanks for watching, and I'll see you in the next one.